get your 30-day YouTube content calendar I use. You'll find the link in description and pinned in the comments. Imagine losing 30% of your portfolio in a single panic sell because you followed a headline. Stay with me 5 minutes and I'll show you the 3 emotional traps that cause that, plus safer habits that protect your money and your sanity. If you want clear crypto basics every week, just hit the subscribe button now and turn on notifications. Today, I'm going to walk you through the most common beginner mistakes in crypto, the emotional trading traps they trigger, and practical low-stress investing habits you can start using right away. No jargon-heavy lectures, just simple real-world advice so you don't have to learn the hard way. Keep watching. By the end, you will know which habits to ditch, which to keep, and how to make smarter moves with less anxiety. Crypto in one line: digital assets secured by cryptography and networks. Why cryptos differ from stocks: 24/7 markets, bigger volatility, and price moves driven by narratives. A quick example would be a major news headline can move Bitcoin and altcoins far faster and farther than a typical blue chip stock. The 3 beginner mistakes. Mistake number 1: chasing hot tips and fear of missing out. You buy after a viral post or Telegram hype. You often buy at the peak of the pump. Real result: high chance of a steep drop. Safer habit is to wait for 24 to 72 hours before after big pumps. Then check fundamentals and liquidity before deciding. Mistake number 2: over leveraging and margin bets. Borrowing to amplify gains seems tempting, but liquidations amplify losses. An example would be 10 times leverage wipes you out on a roughly 10% move. Safer habit is avoid leverage until you consistently profit on spot trades. If you use it, keep leverage low and use strict position sizing. The third mistake is treating crypto like gambling. Random bets across many tokens without a thesis erode your account. Safer habit: limit speculation to a fixed portion of your portfolio, 5 to 10%, and keep the rest in researched core positions. Emotional trading traps and fixes. Trap number 1: fear and panic selling. Trigger: sharp drops and scary headlines. Reaction: sell low and lock losses. Fix: create a predefined reaction plan. The example rule would be: if an asset drops 25%, pause, review fundamentals, then decide. Use checklists and a cooling off period. The second trap is greed and fear of missing out. The trigger is seeing others make fast money. Reaction: chase gains without checking why. A fix is use a decision checklist every time. Purpose: speculation or investment. Market cap: liquidity. Team and token utility. On-chain activity. If it fails, the checklist steps. If it fails, checklist step back. The third trap is confirmation bias and echo chambers. Trigger: community echo that only supports your view. Reaction: ignore red flags, double down. Fix: seek counter arguments, follow neutral analysts, and verify narratives with on-chain data. Safer investing habits. The first habit is risk first, reward second. Always define position size before placing a trade. As a rule of thumb, risk 1 to 3% of your portfolio on a speculative trade. An example would be $400,000 cap, a speculative buy at $4,000 to $12,000. Habit number 2: build a core satellite portfolio. Core, stable, well-researched holdings like BTC and Ethereum Trade less often. Satellite, small, researched altcoin plays limited allocation. This reduces stress and monitoring load. Habit number 3. Use checklists and on-chain data, not headlines. Create a simple entry checklist. Team, use case, liquidity, tokenomics, community. Check active addresses and transaction volume to confirm activity. The fourth habit is plan for security and taxes. Security, use hardware wallets for long-term holdings and maintain good exchange OPSEC for trading. Taxes, track every trade and know local tax rules. Good records prevent nasty surprises. Quick research process. 5 checks, 60-second example. Step 1. Market cap and liquidity. Can you enter and exit without massive slippage? Step 2. Product and utility. Does the project solve a real problem? Step 3. Team and roadmap. Are the devs credible and active? Step 4. Tokenomics and supply schedule. Are there big upcoming unlocks that could dump supply? Step 5. Community and on-chain activity. Are users growing and using the product? Quick example would be run through a hypothetical altcoin with these 5 checks in under a minute. Behavioral routines for long-term success. Do a weekly check, 20 to 30 minute review of holdings, news and reallocation needs. Monthly, rebalance core satellite allocation to stay in range. Daily check would be avoid checking prices obsessively, set scheduled times to review. Journaling, write why you entered each trade, your plan and the outcome. Over time, the journal teaches you what works. Common myths debunked. Myth: you must trade every dip. Reality: some dips are traps, not bargains. Myth: high short-term returns mean a good project. Reality: rapid returns usually equal rapid risk. Myth: crypto is unregulated and lawless. Reality: regulation is increasing. Plan for compliance and taxes. Avoid fear of missing out. Avoid leverage until you are ready. Use checklists and build a core satellite portfolio with strict position sizing. You don't need perfect timing. Consistent rule-based habits beat emotional trading. If this helped, please subscribe and click the bell. I publish clear, actionable crypto lessons every week. Watch next. Explain altcoin research, market cap analysis, narratives and identifying strong projects. The link is on the screen and in the description. Thanks for watching. Protect your capital, keep learning, and I'll see you in the next video.